Hello, cats and kittens. Welcome back to Incubate This.
We have to make her stop doing that.
Irish menagerie.
Oh, did it still come out Irish?
Yes.
Damn it.
It always does.
Hello, everybody.
It's just a deep voiced Irish leprechaun.
And now we're at a 1 in 100 number.
You know what?
That's Jabba the leprechaun.
Maybe I'm just a leprechaun in my DNA, and that's just how I talk.
It could be. But you stopped the air quotes, so.
Welcome back to Incubate This. Today we are talking about unicorns. Not horses with one horn and that are white and, you know, that fly or whatever. No. We are talking about unicorns in the startup world. So Wikipedia defines this as, which the irony is right here in the definition, but it's any private company with a valuation of $1 billion or more. So what does that mean? Private companies are companies that are not traded on a public exchange. So they're not NASDAQ, they're not Dow, they don't have a stock symbol. You can't just go buy a bunch of shares. Which makes the fact that they're giving themselves a valuation of anything kind of funny. So, because it's a private company, and how do you value a private company? Usually it has to be $1 billion. Usually a valuation has to come from some sort of metric that is proof of what people will pay for it, whether that's, you know, they're probably using it from an investment standpoint. So the reason I wanted to talk about this is because I read a story on LinkedIn, and I'm trying to find the link again. I swear you like find things on LinkedIn and they're really good, disappear. And then they like disappear and you can never find them again. If I find it, I will put it on the YouTube channel in the description for this video. But it was talking about a company that is now considered one of these unicorns. It's in a tech space. It's a private company, and they've now raised $205 million in capital. And so from the outside, people are like, oh, if they've raised $205 million, that must mean they're worth at least $1 billion because they'd have to get at least a 5x return in order for investors to be willing to invest in this. They have never made a profit. They're living on this investment money. Now,
are they generating any revenue?
They are generating revenue. Okay. But so let's take a look at Uber, which was, I think, a unicorn before they went public.
Yeah.
Weren't they?
I'm looking at what you just said, and it reminds me very much of the mortgage crisis. It's as if you're saying the value of something is based on what people are willing to pay.
And we're assuming.
And when you're talking about ownership of a company, that's not true.
Yep.
Everybody's expecting it to just keep going up and up and up and up, even though everybody knows it cannot do that.
Well,
you can't just say it's worth $1 billion because look at what people are willing to fork over.
Exactly. And the problem with this is that they're basing that valuation on a company acquiring this company for a 5, 7, 8, 10x return, which hasn't happened yet.
Yeah, I'm sorry. You were talking to Uber, was it?
Yeah. So
they're the worst.
So this is what's so ironic. Lyft is the same, by the way. I don't know for certain, so I don't want to say for certain that they were a unicorn before they went public because I don't know what their valuation was.
Who, Uber?
Uber.
I think they were.
But they are now a 2.5. So last year they had a $100 or $200 million loss on a $2.3 billion valuation. So they're losing 10% every year. They are still subsidizing a portion of every ride that happens on their platform.
So does the 2.5 billion, since they're publicly, is basically a shares outstanding?
That is shares
times
outstanding.
Price.
Yes, exactly.
So, yeah, I mean, well, that's why I didn't think Lyft would be quite the same, because one thing I've read is that a big part of Uber's problem is that they've gone after, let's do, self-driving cars all over. And they had some, monumental failures, bad publicity with that, and a lot of money, big capital expenses that I don't
didn't
know
pan out into revenue.
Had those.
They have not had the same model, but the pricing still doesn't work for volume. Now, so one of the things that I read is that there was a group of guys at Stanford that did a study about this, and they were like, this feels a lot like the dot-com bust, feels a lot like the mortgage crisis, where people are, the perceived value of real estate is more than what it actually is because it doesn't account for the cyclical nature of the economy, which we're going to come back to in just a second.
It's worth whatever I can get the next guy to pay for
Exactly. It's like an
also
MLM.
Known as a Ponzi scheme.
If I talk it up, I was thinking Amway.
Yeah, like MLM or Ponzi scheme is probably more.
Mm-hmm.
So these guys at Stanford did this research study, and what they found is with the companies that were willing to actually open the books to them, because remember, these are privately held companies. They never have to disclose anything. With the companies that were actually willing to open the books, they did an independent analysis and found that almost every single one of those companies was actually overvaluing themselves by close to 48%.
Wow.
Consistently across the board. So
if people are only willing to fork over $120 million instead of $250 million because it's half off what they really think it is, then Uber wouldn't be able to continue the operations that it has so far. They'd be shorter on cash, which then the valuation would start to show what the real value is, because eventually it's going to come out in the wash.
Now, here's my question. Is the value of the massive user base that these companies typically have to get to this point, right? They have millions and millions and millions of users. Is the value of that something that they're taking into account that you can't get from a financial spreadsheet, from a discounted, a DCF model or something like that when you're talking about valuation? And are they assuming that one of these enormous companies, Facebook, Google, these huge companies are going to come in and say, we're okay with the loss because we can make that up in other places because the value of your users is more than that to us. That's the only thing I can come up with is that the data,
you can lose money at the micro level and still benefit.
The data, the users, that's got to be what this is, right?
That would explain, because that was going to be my question, is these investors, institutional investors who are still investing in these, they're doing due diligence, and they've got to be seeing that 48% overvaluation.
Or is it like the mortgage thing where they're like,
they get caught up in
as long as everybody is willing to go this high, we can keep going.
They're following like smart money, and
I just don't know if they're smart or if they're just
everybody's doing
making
it,
billions off this.
Yeah.
My understanding is in that industry, in the investment industry, venture industry, there is a big component of FOMO, fear of missing out.
Yeah.
So.
I wonder how much that contributes. I mean, just because you've this is the thing that we if you're an entrepreneur or a business owner or somebody watching this, and you're in that at that point where you're like, I really want to go raise some money, and I'm trying to figure out my valuation, and you think that the raise is the end goal and that like helps you set a value. What the raise does is keep the lights on.
Yeah.
And it gets other people, I mean, literally, but also emotionally invested in what you're doing. And the more people who are on your train, the more likely it is that you're going to succeed, because part of success is getting people, it's getting traction, it's getting following, right? The raise is not the end goal, though. The raise is how you keep going to get to the thing that actually makes you money.
Mm-hmm.
See, I define a startup unicorn as a company that makes money, that actually has profit. Because, let me put this in these terms. So RVC, when they're looking at deals, when they're looking at doing participating in a raise with a company, and this is true for most venture capital, especially like early venture capital, angel funding, like end stage angel funding, early stage venture capital. They're looking for a 10x return in 5 years. A 10x in 5 years. That's a 60% interest rate year over year if you were to borrow that money from a bank. Which is why in one of our videos, I'm like, it is cheaper to borrow money against a line of credit on your house or write a credit card advance check to yourself than to go raise capital in a lot of cases. But the only way those investors are really ever going to get their money back, it's not really going to be on revenue sharing. It's going to be on the acquisition, which is why so many people
somebody buying in also
to buy out.
Sell.
Yes.
So nobody is really caring if this is real.
Right.
It really, and that's what I meant about the mortgage-backed securities was there was lots of people who started to see that there was crap in these cut up securities that they had and knew that, 70% of what's in there is rated B- or C.
Right.
But, people are still willing to pay it and we can
because it comes
with some other good ones and make
it comes down to the last guy holding the deal.
That's what it seems like as a duck. Yeah. What is that? Duck, duck, goose.
Duck, duck, goose. You're the last.
Or the musical chairs.
Yep. You're the
and
last.
That is the definition of a Ponzi scheme.
Yes, it is. So explain, help me understand how is this private startup not making a profit worth over $1 billion where your acquisition targets are, that's a very small pool.
Well, I think
how is this a unicorn and not just 2000?
It takes a lot of hype,
.com,
and it has to be flashy. The idea has to be flashy, and you have to be aggressive as hell. And that's why those cultures that we've heard about, I think, kind of go along with some of that is you have to be a duplicitous son of a bitch right from the beginning. Pardon my French. Right from the beginning in this process, you have to be, Elizabeth Holmes, where you've hit a point where you realize we're not even close to delivering, and I'm still going to take your money and tell you it's the greatest thing in the world.
Yeah.
Who knows when she knew the truth, but there's plenty of people like that.
Yeah.
Bernie Madoff, all those guys, it's like they knew right from the start they weren't giving you real returns. They were paying you with the next guy's money.
And I'm not saying that I think these startups are doing that. I want to be clear, but it feels that way. How is this not a recreation of the .com bust?
That they're brittle, that when the inevitable next recession happens, these guys they're done.
Tank. How does Uber survive a recession when in the good times they're subsidizing rides?
Yeah. Well, that's the thing is if in the good times they're not making profit, the people with the money are already saying, I'm willing to take a loss. So when the times are bad, I'm just taking a bigger loss. Or, the company's taking a bigger loss.
But in order to keep doing that, they have to keep raising money. So it's not just I'm taking a bigger loss. Now I'm putting more money in against a bigger loss.
I don't know who's doing that.
Now it's publicly traded stockholders. It's the average stockholder. And this is how the average stockholder who's got investments in retirement and in their hedge funds and whatever gets screwed.
Yeah.
My position is that Uber is not a sustainable business model. It's not a profitable model.
It's not because at the level that people are willing to pay.
Yeah, the only way.
As soon as the demand rises enough, the supply goes to meet it, and as that happens, you're just always going to be at minimum wage.
Yep.
Or worse because of expenses.
Yep.
And people are going to drop out at some point. There's probably some people who have a system by which, and this is all about the drivers because I know a few people who do that, and they probably have a system by which they're able to make maybe it's airport runs with a minivan,
right,
where they're actually able to take 4 rides at once,
right,
so that they can get 4 fees while they're making one trip. Who knows? But it seems to me like wear and tear on vehicles, vehicle maintenance alone and the insurance, etc.
Yeah,
you're not making money.
Yeah.
My guess is that their initial goal was if we can put the taxi companies out of business, then we can win.
Mm-hmm.
And I think that was probably overly ambitious. That's
because let's just examine Uber a little bit closer. What taxi business was so incredibly profitable that they were like, yeah, let's definitely get into that because there's margin there.
Yeah.
mean, that's why they're small, independent. There's like 4 in New York City, and they're always competing for the same space. So this month somebody got 25% and this guy only got 15, and next month he's got 20 and he's got 20. And there's not such a huge profit margin in this anyway that it makes sense to take it on at this level. There was no way they were going to put tech behind it and scale this thing, and there was going to be money at the end.
Which is what makes me think from the beginning, it sounds like a really cool idea.
Well, especially when you factor in the
we can
self-driving.
sell the idea.
Yeah. And that's what they were doing. They were talking about the self-driving, because that's when it does become immensely profitable, is when they have their own fleet of self-driving cars that do a good job.
And you don't have to pay the driver.
And you don't have to pay the driver. That's when Uber becomes $100 billion valuation company, right?
But how close are we really to that?
Nowhere near it.
That's my point.
Not reliably.
That's my point.
And yeah, they were betting on the future happening sooner. It is the future. It will happen. But I think they were betting on it happening within 5 years, and it's probably more like 15 to 25.
Yeah, I just find this whole thing.
They didn't disrupt the transportation system because they're still using the same old transportation. I think the only thing that's going to be like the wow, really actual change is when somebody comes up with something that's more innovative, combining public transportation and very convenient short A to B.
Yeah.
And whether that's rentable scooters, who knows?
Well, because that's one of the things that they're in now, right? All those scooters that I see, they're Lyft, aren't they?
I don't think so. I'm not sure that Lyft is. I could be wrong, but I'm not sure Lyft has gotten into that yet. It's Bird and Lime.
But I thought Lyft bought Lime.
Maybe they did. They may have.
I don't know where.
Yeah, and acquisitions
I don't
too
know.
by these people that are losing money.
I know.
That always
They're like,
cracks me up.
oh, there's another company
people.
that's losing money. We'll just buy them, and then we'll get.
We're a bigger money losing company.
But some companies have turned things around by doing an acquisition where they, got something that was a real core business. I was wondering, do either of you know, like, how did Netflix start out? What were they profitable? Were they doing okay? I mean,
I think they've been pretty profitable.
They've been pretty
the whole time.
profitable.
And they started out with just the DVD rentals, right? Before the streaming.
Yep.
Yeah. Yeah. Oh, yeah. They had been in business a good close to 10 years before.
I've actually been with them since 2004. Almost since the very beginning of Netflix, I've been a customer of theirs.
So if a company like that comes up, because that was kind of that was a new way of doing this.
Yeah.
New way and innovative. I mean, that was a real unicorn to me.
Yeah.
I mean, that's what I was wondering.
Would they have been a unicorn? I don't know what their valuation was early on. If people thought it was wild or, great.
Yeah.
Let's buy them through the roof or not.
Yeah, I don't know either. But it's
at least as somebody that I can look at and say, you got a real business there.
Yeah.
You're actually solving a problem.
Yeah. Yeah. Because people hate cable. They hate cable. They hate satellite, like with a passion. They hate it.
I just read somebody saying this, showing some statistics about how many people are dropping cable, and it was like 30-something% or 30 million people in the last 10 years or 5 years have dropped there.
Mm-hmm. Yeah.
It's
so I think it sounds like we're all in agreement about this. If you really want to be a unicorn in the startup world, build a business model that's sustainable, that makes money. And that, yes, if your plan is to raise money through VCs, and you know that in order for them to get the kind of returns they're expecting, you're going to need an exit, do it in a way where the people who are buying you aren't just buying debt and investors. Like there's actually something there. There's a business model there that actually produces money. Right. Maybe it doesn't produce money at a small scale. Like PubTech is one of ours. At a small scale, he can't get the cost per unit down enough to make money. But we have to go through that phase in order to get to the point where we can do the larger scale orders, where we do make money on the devices, and then we make money on the subscriptions, and there's money there. This actually works at scale.
Right.
What his investors are betting on is that we can get to scale with it.
Mm-hmm.
Right? That's a whole different thing than betting on you're going to get acquired by somebody who's going to not notice the loss.
And a lot of these companies, Amazon is a great example. Amazon was probably a unicorn that was losing money But they were doing, Bezos was losing money on purpose.
Right.
Right? Because he wanted to funnel all of that money back into the business to grow it.
Right.
And so if that's what you're doing, that's a perfectly, to me, legitimate way of doing things.
Sure.
Because at any given point, they have always had the ability to say, all right, well, let's bring the prices up on this area to generate some funds.
Then we're back. Yeah.
And then we're back.
Well, and then they came out with the, $99 a year for what is it now? $129 a year. I don't even notice. That's how much I don't even notice.
That's how sinister and effective that is.
How many people?
Well, there's audiobooks.
Yeah.
Anything that just made me think of how many of these people do a subscription model.
Yeah.
Like Netflix.
That's what everybody wants is a subscription
books.
model.
And is that part of what, definitely, when you say we have 30 million users, there's value there because we got their credit card.
Exactly. And if we come up with something where they're like, oh yeah, sure, I'd pay an extra $5 a month for that. There's $150 million a month there.
So could Uber do that? Could Uber say, pay us $100 a month? It's still cheaper than owning a car.
That's what they should be doing.
And I'm sure I'm not the first person who has thought of that.
Let's give Lyft those ideas because we're pretty heavily invested in Lyft right now.
Okay. So
it's got to take something like that, a change like that.
Yes.
For them to go, oh, wow, we actually can make money.
Mm-hmm.
But how do you do that in a way where it keeps the price to where people are still willing to use it? And I think that's the piece. It's like, if this was so killer and the pricing model worked, forget it. It would be over. Everybody would be wanting to buy it because they'd be like, oh my God, people are willing to pay this much for a ride, which means that your margin is this much after you do everything that you have to do. There's money, but there's not.
Mm-hmm.
And people aren't willing to pay more because in markets where they've test bedded, if we actually made money in this market, we'd have to charge this for rides. They drop dramatically.
Right. It's a self-regulating problem.
Yes.
Because if the price is right, there's enough demand. If there's enough demand, they seek out more drivers. As they seek out more drivers, the cars get back to the same level of emptiness that they were.
Exactly.
So it's a self-regulating limit.
Exactly. This
on
is
how much you can
true
make.
Supply and demand. And the margin is whatever people
There's an
are willing to
infinite
pay.
supply.
Yeah.
That's the problem here is that there's a practical infinite supply.
Right.
Pragmatic. I had an economics professor at Metro. In fact, he was the father of one of the South Park guys.
Trey?
Yeah, Gerald Stone.
Oh, okay, yeah.
He was my macroeconomics professor, and he said, he talked a story about when the Hunt brothers tried to corner the silver market. And he said that, they bought up all the silver futures, all the silver, actual silver bullion, but they didn't realize that as the price went up, people were melting down silver sets that they had inherited. He goes, there was literally, there was virtually an endless supply of silver stored up in other places. That if you start making it worth this much an ounce, people are going to go,
okay,
there goes grandma's tea set.
Exactly.
I can get $1,900 for that.
Exactly.
And so it's like that. It's like self-regulating.
This is the same problem with diamonds. If De Beers actually opened up all of their vaults and put all of their diamonds in the market that they have, the price of diamonds would tank.
And in fact, my understanding is they're probably the only reason why diamonds are so valuable to begin with.
That's right, because they own the majority of the supply. They own all of it. So they can put out more, put out less.
And that's something where people can't go home and say, they could pick jewelry apart, but they already got that it's already the same thing.
Yeah.
But that almost makes me wonder if the only way Uber can make money is to make it where you might or might not be able to get a ride.
Right.
It's in high demand.
Right.
It's got to be one of the first 100,
Except that then you have
the
Lyft,
first 100 callers.
Yeah, it's a weird problem.
Or if you don't do Uber and Lyft, you can still walk out on a major street in New York City, raise your hand, and you'll have 3 different cabs from 3 different companies, plus the independent guy.
Or take the subway, or take the bus.
Thank you.
Now, in areas where we live in Denver, I know there are a lot of quote unquote millennials who don't own a car. So maybe Uber is banking on that. Maybe they're banking on the fact that there is a segment of the population that...
But hold on for a second, because I keep hearing this, they don't own a car myth. Parking is the biggest freaking problem in Denver right now. Why is that if none of these millennials own a car and they're the ones buying all these condos?
Well, it's still, I think it's when we were in rush hour in Manhattan in the 80s, my dad said, do you realize only 1 in whatever people who live here own a car? And it's still like this.
Yeah.
Because there's just so many people that they're packing in. Could be that. But are we getting too involved in
how
Uber works?
Are we trying to fix Uber and Lyft?
What are some others?
WeWork, I think is.
WeWork is one.
They lose money.
Yeah,
right, consistently.
They don't. Yeah, and they actually do they own the real estate of the places that they're. Because that's their model is the co-working model, right? But they own the real estate.
I think they do, but.
So for them, a loss in revenue actually isn't the same because there's an asset behind it that is gaining value.
Mm-hmm.
So for them, it's a little bit, if I'm understanding their model correctly, and I just want to be very, very transparent, I don't know a lot about what they're doing. I just know that they're another one that's this unicorn.
And if they do own the real estate.
And if they do own the real estate, then that's something. Because the problem is.
So profitable is not quite the same because you've got an equity income, so to speak.
Right.
You have sort of money in the bank, cash that's just appearing.
Exactly.
As the value of the real estate
And you
goes
could
up.
leverage that real estate in different ways depending on what the economic market is doing. So it's not like with Uber, they're like, oh, well, we have our tech and our IP. And it's like, yeah, there's no value there. People have recreated it.
It's still, though, when people want to invest in real estate, they're looking at cash flow. And you don't have any cash flow here. So
not on a commercial level.
I was going to say there's a little bit more to this than just, oh, well, the value of the real estate that we're helping them support is going up. There's a little more to that. There's definite cachet.
Yeah. So obviously in commercial real estate, cash flow is king and you want to be doing that and you want to be making deals where that happens. However, if you are doing the deals the right way, unlike the way I did it in 2007, if you're doing deals the right way and you have the cash to back the low times, you gain, it is sort of like selling your company and getting the big jump in value the next time that the circle comes back around, right? And so your cash flow is actually more in the good times as the cycle repeats itself because your value is always going up over time. And so your ability to hold that asset, whether you're getting cash flow or not, is actually what dictates you'll make way more on it over time. Does that make sense?
I think so.
And I think I can't think of any other example where that's really true.
Mm. Yeah, real estate's unique.
It's unique in that way.
In a lot of financial ways.
In my understanding, that's a problem that a lot of people are having with WeWork. Is WeWork has been pitching itself all this time as not a real estate play. It's as a technology company, and apparently everybody that's involved are like, there is no technology there. Like everybody across the nation has the same Wi-Fi password and it's something like password with a 1.
Yeah.
I mean, it's that, so I guess their founder has cashed out something like $700 million.
Like the Wendy's commercial. Where's the tech?
Where's the tech?
Yeah, exactly.
Yeah. So there may be a there for
beer
them.
Taps.
They do have beer taps. Yeah. There may be a there, but a lot of people are like, well, where is
it?
Though?
Yeah.
Show us you're there.
Yeah.
What I found interesting, I was like I said, I was looking at Wikipedia and they actually have a list of there's like 360 or fewer of these in the world.
Mm.
I mean, that's how they got the name unicorn. And actually the unicorn is the one that's worth a billion or more. The decacorn is the one that's worth 10 billion or more. And it's like a hexacorn or something that's worth 100 billion or more or 50 billion or more, something like that. I mean, they've sort of like, this term came out in something like 2013 or 14 or something. Somebody described this as this, like, oh my gosh, it's a unicorn because it's so rare. And now, of course, we have to take that and make it like it means something.
Except that kind of coming back to your original point, unicorns are mythological.
That's right. They actually don't exist. So
it's sort of like gate, right? You put gate at the end of everything.
Right.
That's right. That's right. Tech gate. This is unicorn gate.
Unigate, hexagate.
So what was interesting about the list, a lot of these companies are US based.
Mm-hmm.
All the other ones are in China.
Really?
Yes. I think there was like one that was in Saudi Arabia maybe, and I think there was one, it was in Dubai or somewhere in the
Dubai.
Yeah, so it was somewhere in the Arab Emirates.
Somehow related in that.
I feel like.
But is that just a facet of we're the two biggest economies in the world now?
Yes, I think that's true. And how much of our economies are based on these private companies that are overvalued themselves by 48%. Like, it just makes me want to say to China, make a deal with us.
Yeah.
You're not winning either way. Like, make a deal.
You keep your unicorns going. We'll keep ours. It'll be fine.
Oh my God.
Then we'll be back to leprechauns at some point.
Arr. This is the pot of gold at the end of the rainbow. Right. So for me, parting thoughts. What are my parting thoughts about this? One is, don't get so wrapped up in your acquisition or becoming a unicorn, becoming one of these mythological creatures that you sacrifice figuring out how to actually make money in the business that you're trying to build. Because ultimately your investors will get way more out of their investment, will get a far better return if you found a way to make it profitable. Okay, so that's the first thing. The second thing is, if you're an investor, could you call me? Our phone number's on our website. Would you call me and explain to me what you're investing in? I would actually be interested in getting someone, maybe one of our angel investor friends. Actually, I know exactly who I want to get on. We're gonna get a podcast guest. It'll be sometime probably in October that show will air. We're gonna find an investor or two who will talk to us and explain to us what are investors investing in these companies. What is it that they're seeing? What are they betting on? Because let's just be totally honest, an investment is just a very, very calculated gamble. Mm-hmm. Right?
Yep. Mm-hmm.
That's what it is. It's just very calculated. So what is that thing? If you're an investor and you're interested in talking to me or coming on this podcast and you're listening to this or you're watching this right now, call me. I have a couple in mind, but I'd like to get a couple of investors to talk to us about this. We'd like to understand that mindset. It would be interesting to see
that side of it.
Yeah,
for sure.
I agree. And there's two I can think of right off the top of my head that would absolutely be on the podcast with us. So we'll do that. All right. So this has been Incubate This, Daryl Brogdon, Grant Parks, Cynthia Delaria for GotAnAppIdea. And we will, we'll see you at the end of the rainbow, lads. See you next time.